The honeymoon phase for Gen AI is over. Companies just aren't seeing the payback. The costs are enormous for them to use these large language models, and they're not getting the payback. So there was another survey just a couple of weeks before that said that only of those who are initiating this real plans, that they're only seeing paybacks in 5% of the cases. So what's happening? Well, they're slashing spending. These companies are slashing spending on this stuff. Sequoia came out and said there's only $3 billion of revenue that's been generated from Gen AI. Well, you're talking hundreds of billions of dollars that's being thrown at this. It's very reminiscent to me of the internet, which was real, just as AI is real. But in this case, it's Gen AI. It's this large language model stuff. And I liken that more to, tulip bulbs almost, or Celsius bubble, not reality, not in, past manias where they were based on real things like the internet or like canals or railroads. There's no payback, there's no revenues at this point, and we're already a year and a half into this thing. So VC funding peaked in the second and third quarter of last year at like 500 million. It's down 75%. Even they aren't putting money into it anymore. So the question now is, how long can this go on? How long before investors? It seems like the joke's on everyone. Everyone now knows that it's a joke, except for investors on Wall Street, who just keep pouring into the same names. The Vanguard S&P 500 is seeing record inflows. So the index funding is all pouring into the same names. The mutual funds and hedge funds are overweight tech and at record levels. They're all in these same few names. So what could go wrong? So the basis of it all is not real, or it's not anywhere near what it will. I mean, it's not going to provide the benefits that the costs are going to be. So it's a tick, tick, tick. I don't know when it's going to blow up, but it will.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. So far this year, the top 10 stocks in the S&P 500 have accounted for more than 76% of the index's gain. This is the second most concentrated reading for the S&P in the past 20 years. The highest percentage was 79%, achieved in 2007, right before the global financial crisis. So, are we in a new AI-powered tech renaissance that will continue powering the markets higher for years to come? Or are we risking a major market breakdown, putting all of our hopes in only a handful of companies that can't keep growing at the meteoric rates that Wall Street's expecting? For answers, we're fortunate today to speak with Fred Hickey, editor of the highly respected newsletter, The High Tech Strategist, which Fred has been publishing since 1987. Fred, thanks so much for joining us today.
Always a pleasure.
It is always a pleasure, Fred. Thank you so much for coming back on. I want to just dive into things here with you, because the last time you were on this channel and we were digging into your outlook, if memory serves, you were fairly concerned about the valuations in what we call the Magnificent Seven back then. I think that number is now dwindled down to the Magnificent Four, Magnificent Five. I guess maybe five. I guess we can put Apple back in it now.
For sure.
Yeah. And of course, valuations have only gotten much more distorted since you and I talked. So I got to imagine your level of concern, as high as it was last time we talked, is even higher this time around. So I want to dig into all that with you, but if we can, let's just kick off with the general question I like to ask you at the start. What's your current assessment of the global economy and financial markets?
Well, starting with the economy, I think globally it's relatively weak. The U.S. has the strongest economy, and it's a pretty mixed picture there. If you look at China, they just had results out today for production and retail sales and housing, and their housing prices fell, existing home prices fell 7.5%, which is a terrible number. And their industrial production was weaker than expected, and retail sales were soft. And that's the second largest economy in the world. Europe has problems. We'll see what happens with the French election coming up shortly. But there's a lot of issues there. They've been in and out of Germany, particularly in and out of recession. Japan has been in and out of recession, barely growing at all. And then you have the U.S. And the U.S., if you look at it, the high-end Americans are doing well, mostly because of stock market wealth and real estate wealth. And the rest, those who do not own those assets, are doing relatively poorly. So I saw a statistic that said that 60% of households with four people in it are struggling financially. Those are with 60,000 income and up, and they're struggling financially. That's a large number of people. If you look at retail sales, they've been weak, but if you inflation adjust those retail sales, they're negative. About the only major retailer that's doing well is Walmart, and they're seeing a big shift in their sales from groceries, which half their sales, to groceries and healthcare from other areas such as discretionary electronics spending. Target's terrible, Kohl's terrible, Home Depot, they're all awful. If you look at the jobs picture, it's somewhat mixed, but I think it's pretty terrible. Only because I don't trust the payroll survey, which came out with just this latest number, a better than expected number of about 270,000 added jobs, but almost all of those, 90%, were from the birth-death model. And the birth-death model is just a computer model that's wrong at turning points in the economy, because it's they just make they make guesses as to what small and new businesses are doing, and at market turns, they're always wrong. If you looked at the household survey, you saw 600,000 drop in full-time jobs, an increase in part-time jobs because people are taking on two jobs. We've seen the JOLT survey. We've seen those job openings drop from 11 million to 8 million openings. So from a jobs perspective, it's not great either. There's definitely a slowing going on there. The unemployment rate has risen from 3.4% to 4%. And when that happens, when you get a 0.6% increase, that usually precedes recessions. Industrial production, weak. 18 of the last 19 months, the ISM has been in contraction. Orders and backlogs are 45 and 42, and 50 is the dividing line. Real estate, obviously the home market, housing market is very poor. It's mostly, you could say it's in the doldrums, it's frozen. People can't afford homes, young people particularly. So the average income required to buy the median home is 115,000, but the average income is only 75. So you have the worst affordability since the 1980s, when Volcker had lifted interest rates tremendously. So the only area that we really have strength is in experiences and going to sporting events and Taylor Swift concerts and traveling to Europe for the summer vacations, and that's from the high-end people, where we've seen huge amounts of wealth that have been created by mostly the stock market, but also in the real estate market. And over the last 4 years, that's up. Household wealth is up to $160 trillion, and it's up 45%. But it's all in the high end. So it's a very bifurcated economy here in the U.S. And so what that tells you then is that that the part of the economy that's still doing well is dependent upon high asset prices. And if those asset prices fall, then nothing's going right. And eventually here, asset prices will fall, because last time we talked in November, they were insane, and now they're ridiculously insane. Herb Stein said, if something cannot go on forever, it will stop. I don't know when this bubble will break. I think it's the greatest bubble I've ever seen. And I've been an investor, active investor for 45 years, so I've seen some. When you see, you had some statistics that you had thrown out earlier, but Nvidia went up $1 trillion in 1 month. Okay, Apple's gone up $700 billion in 6 weeks. Apple does not have good numbers. Their latest report was a decline in revenues. It was the 5th decline in the last 6 quarters. They had negative net income. Their iPhone sales dropped 10%. Their international sales were down 6%. This is not a justification for a $700 billion increase. We used to have, the first time we ever hit $1 trillion for a market cap for any company, it was Apple in 2018. We had one, just Apple. Since then, their revenue growth has been 5% compounded. The stock has gone from that $1 trillion to $3.3 trillion, or 35%. I mean, it's unbelievable how much it's gone up 3.3 times from the $1 trillion. We now have three $3 trillion companies. We have Microsoft, Apple, and Nvidia. We have two $2 trillion companies in Amazon and Google, and one in Meta, $1 trillion. It's just stunning. Yeah, as you said, 76% of the gains coming from these 10 names. Three of them, Microsoft, Apple, and Nvidia, are now supposedly worth at $9.8 trillion, are now worth more than the higher Chinese stock market. This is just staggering kind of stuff. What's happening is what has happened before. It's a fear of missing out or fear of getting fired if you're a fund manager, and they all have to pile into these same number of names. It's getting narrower and narrower. They have to go into the ones that are working, or they'll get fired because they're going to underperform. So it's sort of like FOMO, except it's fear of getting fired. And so we have this narrowing of the market. The breadth is horrible. Advanced declines. There's more decliners than advancers. You have more 52-week lows than highs. You have volumes declining in the stock market here, particularly recently. These are all indicators of a weak and unhealthy stock market, and it's getting narrower and narrower and narrower. And it did that. It's done this before. We saw this in the Nifty 50 in the 70s. Everybody was piling into RCA. I wasn't around for that one, but everybody was piling into RCA, drove that up before it collapsed 97% in 1930s. This is a human behavior. Human behavior doesn't change much over time. The numbers change, the names change, but the activity doesn't. It's Charles Mackay of Extraordinary Popular Delusions said that men think in herds, they go mad in herds, and they recover their senses only slowly, one by one. And I think that's where we are. We're at the point where they haven't recovered their senses yet. It's pretty crazy stuff, because the names that are winning here are all Gen AI names. And I've talked about AI being real. It's been around for decades. It's part of our everyday lives. It was in Siri before. It was in Amazon's Alexa before. It's been used in industrial situations. Any kind of phone calls that you make to banks, you're using AI. What we had in the beginning of 2023, and I'll point out that happened after the stock market had crashed, after Nvidia had lost 68% of its value in 2022 in 11 months. What we had was Microsoft decided that with this new large language modeling, which OpenAI kind of created here, they could make a run at Google, or as the chairman of Microsoft said, we can make Google dance. So they poured $10 billion into OpenAI. They bought incredible amounts of GPUs from Nvidia, and they were going to make a big run with their search engine, Bing at the time. Well, it still is Bing, and against Google search, which controls the market. So they poured all this money in, and Google said, we can't let this happen. We're going to have to do the same thing and improve our search box with AI, and they did. They also poured billions upon billions of dollars into Gen AI, and then Meta got involved, and Amazon got involved, and others got involved, and now we're at a point where this year they're going to spend, these hyperscalers are going to spend $200 billion just on this Gen AI capital investments. Now, problem is that Gen AI really isn't much of anything. It's an evolutionary, rather a revolutionary type of change. Nvidia's Jensen Huang talks about it being the next industrial revolution. Well, that's craziness, but it's the kind of stuff that is bandied about in manias. And so, but if you look at Gen AI, we know about the hallucinations. We know about the wrong answers. We know about how if you ask Gemini, Google's Gemini, questions, and you get answers like, well, you should eat a rock a day, it's good for your health. Well, that's craziness. But and when Google went back and found out how they could give that answer, they found out that it came from the Onion. It was satire. There's no thinking in Gen AI. There's no intelligence. It's great at regurgitating the contents of the internet, but it gives you wrong answers. It gives you hallucinations, and it tells you that you can make sure the pizza doesn't slide off, the cheese doesn't slide off if you use glue on it. It's just craziness. And what's happened now, this has been going on for now a year and a half, and companies have been trying this, and we're seeing that they're not getting anywhere. So there's a company called LucidWorks last week that came out and said the honeymoon phase for Gen AI is over. And they said that because companies just aren't seeing the payback. The costs are enormous for them to use these large language models, and they're not getting the payback. So there was another survey just a couple of weeks before that said that only of those who are initiating this real plans, that they're only seeing paybacks in 5% of the cases. So what's happening? Well, they're slashing spending. These companies are slashing spending on this stuff. Sequoia came out and said there's only $3 billion of revenue that's been generated from Gen AI. Well, you're talking hundreds of billions of dollars that's being thrown at this. It's very reminiscent to me of the internet, which was real, just as AI is real. But in this case, it's Gen AI. It's this large language model stuff. And I liken that more to, tulip bulbs almost, or Celsius bubble, not reality, not in, past manias where they were based on real things like the internet or like canals or railroads. There's no payback. There's no revenues at this point. And we're already a year and a half into this thing. So, VC funding peaked in the second and third quarter of last year at like 500 million. It's down 75%. Even they aren't putting money into it anymore. So the question now is, how long can this go on? How long before investors? It seems like the joke's on everyone. Everyone now knows that it's a joke, except for investors on Wall Street, who just keep pouring into the same names. The Vanguard S&P 500 is seeing record inflows. So the index funding is all pouring into the same names. The mutual funds and hedge funds are overweight tech and at record levels. They're all in these same few names. So what could go wrong? So the basis of it all is not real, or it's not anywhere near what it will. I mean, it's not going to provide the benefits that the costs are going to be. So it's a tick, tick, tick. I don't know when it's going to blow up, but it will. And when that does, then your wealth goes down, and then the strong part of the U.S. economy goes down. And then you have a real problem. And then we could get into tax revenues to go down, and your budget deficit, which is already running near $2 trillion, goes up, and your debts go from 35 trillion up, and all of the other problems that would occur as a result of this. So, this is where we are. We're the whole world now seems to be tied to a few stocks that just go up every day. Apple's up another $5. Okay. And it's funny because they'll shift between Nvidia and Apple. Nvidia's going down, and Apple goes up. Nvidia goes up, Apple goes down. It's wherever's moving today. That's how investors are. Has nothing to do with valuations. I mean, Nvidia is selling at 41 times sales. And these sales aren't going to last because I believe that they're gonna fall apart once companies realize they're not getting the payback. And you know, the hyperscalers that are putting $200 billion in this year will not be able to continue to do that. So we're already seeing Nvidia's growth rate fall. They had tremendous revenues. Everybody poured in all this money all at once, and the revenues last quarter were up 262%. Well, next quarter, 100%. And what we've seen in the past, because Nvidia is a giant roller coaster, cyclical semiconductor company, what we've seen in the past is that once the growth rate starts to drop off, a few months later, Nvidia's stock starts to drop too. So we're almost at that point where we're going to see some pretty big, pretty dramatic declines in Nvidia's growth rate, and maybe that takes the market down too. I'm not sure about that. You know, and give some perspective too. Intel was as dominant today as in the microprocessor market, the CPU market in 2000 during the dot-com bubble, more so than Nvidia is dominant in GPUs. Intel's market cap peaked in 2000 at 500 billion. Okay, we're saying now Nvidia is 3.3 trillion. Okay, 6+ times that. Now, if you inflation adjust that, it comes to 945 billion for Intel's so comparable cap. It's still 3+ times what Intel was. I mean, what Intel was. And what happened to Intel? Well, Intel peaked at $76 in September of 2000, August, September of 2000, and fell 80-something% when that bubble broke, and it never recovered. It's $30 today. So 25 years later, it's $30 today. But we're orders of magnitude higher in Nvidia's case, yet the internet was real. The internet was going to change the world, and did. Whereas Gen AI, now AI was growing for decades slowly. It was improving Nvidia's piece of their business little by little, as it was. But Gen AI is the thing that drove everything skyward here at the beginning of 2023. And I think part of that, one of the reasons why we had that is that in 2022, the Fed started raising rates. They were tightening. We had QT. They raised rates, you know, from 0 to 5.5%, and the markets got crushed. The Nasdaq fell 33%. The bond market had its worst market in history. What happened at the beginning, in end of 22, early 2023, is there was money left over from that money printing, that $5 trillion that the Fed had printed, and it was sitting in what's called the RRP account, the reverse repo account. $2.5 trillion at the beginning of 2023. Well, Janet Yellen has been able to unlock those funds and has pulled out over $2 trillion, starting in right around the beginning of 2023, pulled out $2 trillion, and that money, a lot of it, went into the financial markets. Just as QE1, QE2, QE3, QE4 did as well. And that's when we had those big moves in the market. Now, when the Fed printed at $5 trillion, a lot of that money went to the consumers. And then we ended up with consumer inflation. Before, in the QEs, it was all asset inflation. Well, this is what we have again, asset inflation. Consumer prices are coming down because the consumer's not getting any checks. They're out of cash. Their excess savings is exhausted now. So the money's going to financial assets, and it's driving these prices up, and it has been for the year and a half. And that's what it just so happened that it coincided with Microsoft's attempted move into Google's search space, and then everyone else piling in at the same time. And then the story comes that Gen AI is going to change the world, become a new industrial revolution, all this stuff. It's all been fed by this $2 trillion that was unlocked when Janet Yellen found out that if she issued a lot of T-bills, the money would come out of the RRP. And it did. And now we're down to around $400 billion in the RRP. It's been stuck there since March. None of that money's coming out anymore. And the Fed continues to do QT, meaning tighten, reduce their balance sheet. They've reduced their balance sheet from 8.9 trillion to 7.2 trillion, and it's still coming out, but at a lesser pace. They're still tightening, and now you don't have the RRP. So I think that's one of the reasons why the market's getting narrower and narrower and narrower. There isn't the money out there to propel this stuff. There's only enough to propel these 10 stocks or 3 stocks or whatever you want to use.
All right, Fred, that was amazing. I had so many times I wanted to jump in and interject, but I didn't want to interrupt because you kept going in the direction I was hoping you would go into. I do have some key questions for you, though, and I just want to comment here that you're publisher of the High Tech newsletter, right? You're one of the top experts on the technology sector. And one would think that somebody who publishes a newsletter like that would be cheering stocks, the tech stocks and AI, right? But you're a data-driven analyst. You've seen your share of bubbles in the past. And I just think it speaks volume when somebody like you, who is a longtime veteran and maybe even has a little bit of an incentive to be a cheerleader of this space, is very loudly stepping up and proclaiming this space is incredibly overvalued. This is not going to end well. I know you want to comment here, but let me just ask you this question. If I follow the breadcrumbs correctly from everything that you said and try to distill it down, this is kind of what I get. I get that because of how all this money has sloshed into fewer and fewer stocks, and trees don't grow to the moon, and at the base of this all, you're saying there's really not even any real there for AI, given this massive scale of money that's gone in there. You think the progression here will be the following: we will see the growth rates start coming down in these market leaders like Nvidia. You're already saying we're beginning to see that, right? And it's true, because you can't grow at hundreds of percent, every year forever as you get bigger. That will then eventually start reflecting in a decrease in the stock price. So growth rate goes down first, stock price goes down second. Because the market is supported by this very small number of players, when their stock price goes down, it's going to drag the markets down with them, especially because these stocks are so widely owned across so many different ETFs. And then when that happens, that's going to drag the economy down with it, because consumer spending, the negative wealth effect, all that type of stuff is going to start hitting companies hard, in lower sales, in companies having to lay off to preserve their profits, et cetera. And then the danger of a recession really becomes really real then. You're sort of nodding as I'm saying all this, but do I have that progression generally right?
You have it. You've summarized it very well.
Well, thanks. Okay. Nice to know I'm a good note taker here. All right. So I think the thing that maybe you said that maybe was news to people is, because you're a technology specialist, and again, one might think you have a professional bias to be kind of bullish all things in the technology sector. One would think that you might be kind of an AI bull, but you really do not sound like one. And so, you're basically saying, look, the hundreds of billions going into this space, you think are going to, I believe, going to largely be wasted. I guess first,
not unlike what I saw in the fiber optic craziness in 2000, and the computer server, and then and the storage. That's what happened then too. Same thing.
okay, so to you, this does feel like a movie you've seen before, then, to a certain extent. Let me just ask this before we flesh that out a little bit more. I mean, there are going to be some benefits of AI. Now, maybe they're going to be far too small to generate a positive return on the investment that's being made right now. But just before we throw the baby out with the bathwater here, we're making huge investments in AI right now. What benefits would you expect to see from that? And again, forgetting about the ROI of the costs, like, will we see more efficiencies? Will we see a greater increase in productivity from all the money going in now? Or is this truly just pure wasted money?
As I said, AI has been with us for a long time. Okay. It's been improving productivity, improving lives, all very slowly, for decades. And that continues. So I believe in AI. What I didn't believe was this generative large language model. there are some benefits that will come from that. I mean, for example, quicker translation. If I'm in Costa Rica, I can use my phone. In fact, you can do this with Google's phone, Android phones already. I saw it demonstrated down there. I go to a local barber down there in Costa Rica, my second home, and he doesn't speak English, and I don't speak Spanish very well. And we both speak into this phone and we can understand each other. Well, that can be done more efficiently here using Gen AI. That's one example. There are also some benefits to writing code. If you think it's important, summarizing your emails, but there are changes that are on the fringes. It's not, these are improvements, they're evolutionary. It's not an industrial revolution. AI will continue to improve our lives, our productivity, slowly, as it has. But this large language model, which is modeling, which is what this whole bubble was all about here over the last year and a half, that's where they're pouring the money into. The hyperscalers are pouring all this money into that. That's where I'm skeptical. I mean, even Microsoft hasn't gained any share. They're the ones that kicked this off, and they haven't really gained any share against Google in search yet. Now, Google may be threatened somewhat. There may be some disruption there, but so far, not much.
Hey, let me
It's
ask a
not a
question on that
major
then.
change.
Let me just, because of that. So you're almost saying like Microsoft hasn't really seen much for its kicking off this AI arms race, but their stock has gone up dramatically as part of this. But so are you essentially implying that a big chunk of Microsoft's market valuation right now is kind of phantom valuation?
Yeah. Well, they're the one company that actually is generating some revenue because they're charging $30 per person per head in corporations that want to have the higher end Copilot, which is basically OpenAI's ChatGPT behind that. So they're actually generating some revenues. Nobody else is. Meta is giving theirs away for free.
Okay,
Apple's
they're
for
generating
free.
some revenue, but I mean they've had $1
It's not
trillion
much.
plus tacked onto their
No,
market
no.
cap.
If you look at the market, it's a 38 PE. Microsoft's a single-digit grower. Much of their growth recently, and over the last several years, has come from roll-up acquisitions, including the big acquisition they did for the gaming company here recently. Other than that, they're low single-digit growth. A 38 PE, 14 times sales. That's unheard of. So much of the market valuation growth that they had, it's not as big as Nvidia, not as crazy as Nvidia's and Apple's has been. But at least they have growth. Apple hasn't even had any growth in this last year and a half. It's been declining revenues. Nvidia's had lots of growth, but I don't think it's sustainable. It's just one big surge of spending that occurs. So Microsoft is, you could say will benefit somewhat from this for sure, because they're able to, in their position of power in the enterprise, are able to charge people, but most everyone else can't.
Okay, and I just want to make sure, I don't think you're saying Microsoft can make enough from this to justify its increase in market cap that it's seen from this. It'll make some revenue,
No.
but okay.
You're talking about it. Usually it's a teens kind of PE, right? I've seen a single digit in downturns, just like Apple. Apple, when it used to grow, was in the mid-teens, and now it's a 33 PE. That's not sustainable.
Okay, so I want to get to how you think this is likely to unwind, kind of the how bad could this get question. Real quick before I do, let's just talk about whatever is relevant to say about the key players. We just talked about Microsoft a little bit, but so Apple, Apple, their stock the bloom was off the rose on their stock this year until quite recently, and then it's added more market cap in the past 6 weeks than Tesla's entire market cap.
Mm-hmm.
And I know you think Tesla is probably still overvalued too.
Yes.
You're nodding as I'm saying this. And they basically, I don't follow the industry nearly as close as you, but they basically said, hey, we're now taking the chocolate and peanut butter and putting them together. We're taking the iPhone, Apple devices and AI, and now AI stands for Apple Intelligence, right? And it's basically OpenAI, integrating OpenAI into Apple. As far as I know, they're not going to be charging people for this. Apple hasn't written a line of code for OpenAI, so it's not even a product that they, code themselves. But all of a sudden, the market said that sounds like such a great idea that we're just going to give you gazillions of dollars of market cap as a result. And you went earlier on through the litany of how Apple's not growing, and all the reasons why you shouldn't look at this as a growth stock. So anything else about Apple that we should mention?
Yeah, I mean, Apple was $169 on May 1st, before it reported poor earnings, disappointing earnings, really bad earnings, and the stock jumped. It was 20 points right after that earnings report, not on the earnings, obviously, but on the notion that they were going to introduce their AI plan here, as they did last week, I think. They would introduce that, and also because of a big buyback, they announced a $110 billion buyback, which I'll point out, they announced a $90 billion buyback the year before that, and they only purchased $77 billion. And the number of shares they've been buying each for the last several years have been declining because the stock price is too high. But they got that big leap, and then when they actually had when they had the Worldwide Developer Conference here this month, and they introduced AI, it was a pre-programmed, canned, not live, not a lot of details, and it was pretty, except for some of the real cheerleaders on Wall Street, it was panned. It was underwhelming. It fizzled. Gene Munster, who's been a big Apple supporter for a long time, said that people aren't going to buy this. These features that you mentioned here, and aren't even available yet, they're not what phone buyers buy. They buy size of phones, improved battery life, improved cameras. He doesn't think this is going to move the needle very much.
And sorry to interrupt, I'll let you keep going, but that does seem to be a refrain we're hearing more and more about AI, which is sort of the "where's the beef" refrain. Like, where's the killer app for this, right? I get it's going to potentially change our lives, but show me the thing that makes me think, yes, okay, this is revolutionary, right? We're just not seeing that.
Yeah, I think, as I said, I think you have to make the distinction between AI, which has been making improvements in our lives for a long period of time, but slowly, and this generative AI, which exploded on.
But generative AI, yeah, they're still waiting for the
Apple's trying to do. They're putting large language modeling into their phones. They're going to offer that, and with some features that but they haven't been able to describe anything that's a killer app, as you mentioned. It has no there right now. And to think that we're going to have a big jump, well, I mean, some of the analysts are calling for another super cycle in phones, but it's a saturated market. We had an explosion that occurred in 2021, which is only 2.5, 3 years ago. We had an explosion in demand where phones went to 1.4 billion in the year of 2021, and everybody upgraded because they were given cash from the government. So
and that was basically the stimmy check effect, right?
Yeah, stimmy checks, and same thing happened in PCs. They went up to 350 million PCs, so they're back down to 250 million, which is the run rate. And PC market has been stagnant forever now, seemingly. It went 7 consecutive years with negative growth, and then picked up for just a couple of years, and then went negative because that was extreme. And now we're back to predicting 1% and 2% growth. And it's the same thing in the smartphone market. Those are mature markets. And I think it's also one of the reasons why the technology world wants this to work. There weren't any major drivers, big growth drivers for Silicon Valley, and to get the stock options up and their stocks up and everything. But this came along, this generative AI thing, and I just don't think it's going to have that much of an impact on people's lives, and I don't think people are going to be running out and buying their phones. I saw a survey, I think it was UBS, that said that only 27% are even interested in upgrading their phones at this point. And we've seen Apple's those features that they had at their Worldwide Developer Conference when they reintroduced Siri and everything. Those are features that Google has, and most of the Android world already has. But when Samsung brought out their phones, their AI-based phones, these AI phones are already out there. They're not selling that well already. We already know that. So it's not like Apple. Well, I guess, some Apple people will always buy the latest and greatest thing, but in an economy where the majority of people aren't doing well, where they're struggling financially, and remember, Apple sells in the US, they sell to everybody, not just the high end. They sell to everyone. Everyone owns Apple iPhones in the US. And so if the population is struggling, they're not going to want to upgrade for something they don't understand where they're going to get a benefit from.
Yeah. Yeah. And I did want to try to get into your comments about the bifurcated economy, where we basically have a small percent of very wealthy that are doing great and kind of keeping the averages up. And then everybody else below them increasingly doing worse and worse. I've talked about it a lot on this channel. If we have a little bit of time, I'll try to squeeze it in. But I do want to get to the how bad could it get question. Before we do, let me just say, maybe we can't dial through every one of the current Mag 5, but is there any other observations about any of those companies you want to mention before we move on?
Well, Microsoft's the most solid of all of them. Amazon has Amazon Web for the cloud. That's a strong point for them still. Meta's blowing a lot of money in metaverses and things like that. And now I'll tell you one thing I will talk about is how their earnings are all inflated. All of them. And now we all know, we've talked about this before, how most of Silicon Valley strips out stock-based compensation. They pay themselves in options. And oh, by the way, everybody in Silicon Valley is dumping their shares. Everyone from the chairman on down in Apple are selling shares. Jensen Huang announced a $730 million equity sale here. You have Michael Dell selling $3 billion worth of stock. They're all unloading here because they know this. I think they all know this isn't going to last.
Wow, that is
So
a
they're all
classic
unloading all these
late
shares.
stage sign. Yeah.
But so we know that they've been, through financial engineering, writing off things and not including the real costs of labor, which is the primary cost many of these companies have. But in addition, this is the latest in the last 3-4 years. So they're spending this $200 billion, these hyperscalers. They're putting all this money in, and that would go onto the balance sheet. These are computer servers and network equipment, and it would be depreciated over time. Well, over the last 4 years, these all of them, Microsoft, Amazon, Meta, Google, have been raising their assumptions for computer server life. First from 3 years to 4 years to 5 years to 6 years. So they have assumed now that computer servers live longer, that are more useful now, twice as long as they were just a few years ago, just 3 or 4 years. As a result of that, you cut your depreciation expense in half.
That's exactly what I was just about to ask. Okay, so
Yeah.
it's to stretch the depreciation out over a longer period.
Yeah, so it's their numbers would be far lower. We're talking billions and billions and billions of dollars here. That because they have done more financial engineering, they're stretching out their depreciation expense and reducing it and inflating their earnings. So that should be known. You don't hear much about that.
No.
So you talk about these earnings out there. You talk about PE ratios for 33 or 38 for Microsoft, or some of these other ones that are they're 50 for Amazon. Well, they're a lot higher than that.
Wow. That's interesting. I haven't heard that. Okay, one last question on individual stock. Nvidia, I have heard, I don't know enough to talk about this knowledgeably, but I have heard accusations that Nvidia may be guilty of the type of like round tripping shenanigans that we saw back in the .com
Yeah, it was
market.
called vendor financing then.
Yeah.
Yes, so Cisco was doing a lot of people were doing it then. They were funding their customers. And yeah, I've heard, well, we know that Nvidia has poured huge amounts of money into CoreWeave, and they will go out and they buy Nvidia chips. Okay, and now they're starting to get into the hyperscaler kind of business, the cloud server business, but they were buying chips and it was being funded by Nvidia. So there is this round tripping going on now. Supposedly there's upwards of 20 companies like that, but CoreWeave is a big one. So, whenever you have shortages like we had, when they all poured all this money, all these hyperscalers all at once, so they wouldn't be left out, fear of missing out. When they all did that, you had ended up with shortages, probably the greatest shortages I've ever seen. And so people tried to hoard those, and prices are up. The prices were continuing to go up at the time, and so they were winning with that. The more you could get a hold of, the richer you were becoming. And that's one of the reasons why the semiconductor market is so cyclical. When there are shortages, people will double order, triple order, get their hands on these chips any way they can. And then when reality sets in, then orders collapse. And so one of the things that was being done here, Intel did the same thing. Intel established the venture capital fund back in the late 90s, early 2000s, and that was going on as well. But it was really like Cisco and Sun and those guys, some of the telecom companies, they were all funding their customers. And sounds like it is the same. I know that's the case in CoreWeave. These other 19 or so that I heard about, I'm not sure all the individual details.
Okay, but you feel like there's certainly some smoke there and probably some fire. We'll figure.
There's a whole bunch of ordering that wasn't there of chips that isn't needed.
Okay.
And that will end.
All right. Well, let's then go into my big question here, right? Which is, okay, so Fred, what do you think is the likely denouement of this? What's the outcome? And assuming it's negative, which I think is a pretty safe assumption at this point, how bad do you think it could get? Even just to your last point there, if folks start waking up and saying, you know what, we've thrown way too much money into the space, we got to dramatically decrease the spending, that obviously crushes companies like Nvidia. They're priced for perfection, so obviously their stock will probably get hella hammered as they start having to disappoint the street and walk back their forecasts. But then you talked about how the semiconductor kind of goes in a boom bust cycle. We will very quickly go from boom to bust, right? As all of a sudden we have a massive, I would expect a massive glut of chips from this, right? And then you'd have
in the AI area, though, that it's less so in most of there is an inventory glut across the semiconductor market, but it's nowhere near as bad as it is in the AI related stocks, the beneficiaries like HBM memory for guys like Micron, in Broadcom and Nvidia. That's where the greatest gluts are. The rest of the market, we had a boom and we had a great glut in semiconductors, and we've seen a lot of that inventory worked off already. So it's concentrated in this particular area.
Okay, so it's concentrated in the generative AI area.
Yes.
So it'll hammer those stocks.
Right.
And then what do you expect the type of damage to be on those that are building tomorrow's applications for generative AI, the Microsofts, the Apples, the Googles, et cetera?
We know what happened in 2000. The tech stocks dropped 80-something%. If the market was left to its own devices, we would see a repeat of that. I've witnessed Nvidia drop 5 times in the last quarter century by 55% or more. That one dropped 89% in 2002. It dropped 85% in 2007 to 8. It dropped 68% just a year and a half ago in 2022, and there were other 2018 was 50-something%. You're going to see, if left to its own devices, Nvidia would collapse 80 to 90%. I'm certain of that. However, what's the Fed going to do? What's the Fed? Are they going to allow all of these trillions of dollars of wealth and the effect it's going to have in the economy and sit by and not print again? Because if you keep printing, then nominally asset prices hold up better. And I suspect they will. So I think we get really sharp declines, but maybe it won't be 89% or 85% as I've seen before in the other bubbles that we had with Nvidia. In 2000, everything fell apart. And all of those, one of the misconceptions is, I keep hearing that, it bothers me. They say, well, it's different this time. Famous saying. It's different this time because those companies back then in 2000 weren't making profits like these companies. And I say that's bull crap. All the major companies were making money. Microsoft, Cisco, Intel, they're all making tons of money. And as that build out of excess equipment, it turns out, they were all making money just as these companies are. But when the growth rates fell, then the stocks collapsed too. So, I expect you're gonna see a reversal of trillions of dollars of wealth amongst these very large companies, and it will have effect on the whole market. Obviously, the ones that aren't performing, look at the cloud stocks. They're not even performing anymore. So in the last quarterly results, 8 of the 10 top cloud companies, including Salesforce, the biggest one, they all dropped by an average of 9%. That's how narrow this market is. Even the cloud stocks aren't performing anymore.
Mm-hmm.
When the consulting stocks aren't performing. When Accenture and IBM reported, they got clobbered too when they reported results. It's really concentrated in just these few names, and they're all tied to this generative AI thing. So I don't know about the market averages because I don't know what the Fed will do.
Okay.
I assume that they'll print.
All right, so let's talk about the Fed and its reaction function more in just a second. But the dominoes go down. Nvidia, you think, if left alone, could go 80, 90%. The other guys, just give me a ballpark average.
Well, like I said, Apple used to be, when it was a growth company, would trade in the teens, right? 15. Well, it's 33 now. So cut it in half, right?
Okay.
Microsoft 38. Well, it's again mid-teens, single-digit growth company, maybe less, right? But it's at least a more solid company. It controls. It's a great company. So you're talking about 50% declines, anyways, right? That's what would be. That's what would happen if the Fed didn't come in with another printing campaign.
And so, what would happen to the general market, do you think, given how widely owned these stocks are?
Well, hopefully, we would have a recurrence of what happened in 2000, which was the tech stocks got clobbered, and the value stocks that have been abandoned do better, and first relatively better, and then the following years actually have their best performance in decades, and much of the market has been left for dead here. It's the small cap stocks are down 2% this year. The mid cap stocks are up just 4%. The 400 index and the S&P. There's nothing going on excluding these few names. So they'll rebound. The value areas will rebound, assuming the economy doesn't completely collapse. And that would be the hope, is that you would get a shift once again from these high growth stocks to value.
To value. Okay. So just getting back to my question, what's different this time around, I believe, versus 2000 is the fact that 38 cents of every dollar that goes into the market goes into one of these high flying stocks we talked about. Yeah. Mm-hmm. And so one would think that if there are capital outflows of the market, you'd get the same thing, right? And because so many ETFs of all different stripes and sizes and themes own these stocks anyways, you would expect it to be less contained than it was in 2000, right? That the general market indices will get hit harder. And where I'm going with this is sort of people's retirement accounts. It's like we will feel the injury of this probably more than .com from a breadth perspective.
And one of the problems is because the Fed has come in and supported the market so many times now, people are taking risks. Baby boomers are taking risks. They have huge percentages of their money in stocks. And when we talk stocks, then it's often the indexes, right? Which means that they own 38% of these 10
That's my entire point here. Exactly. Yeah.
Right. So, and they're not ready to, they don't expect that. So, unless the Fed can support them again. But if they can't, now one way they might not be able to is because last time around, they had to send money, stimmy checks and things the government did when they printed the money, it went into the consumer, which caused inflation, which put a limit on what they could do. Even now, that a lot of people are screaming that the Fed is too tight, as we talk about all these economic areas that are in decline, that they're too tight. Well, that's because inflation is a problem, and expectations of inflation are still a problem. If you go to the grocery store and you see food costs, they're up 36%. And so that might put a limit on what the Fed can do. One of these times they won't be able to, and maybe the bond market has a real problem. We didn't even get into that,
Right.
where the bond auctions aren't going well, and the liquidity in the bond market is poor, and China is pulling out money in large amounts, record amounts of money from selling their treasury bonds. We might not have enough buyers for treasuries, and rates might go up. There could be all kinds of problems here, which are hard to play out.
They are.
But
And just to get to the point of the Fed, let's assume that the Fed and the fiscal folks say, hey, you know what? We don't like bad things. Let's step into backstop, like has been their playbook of late. There still is a reaction function to it. And let's talk monetary for a moment. If the Fed says, oh gosh, okay, you know what? Let's start cutting rates like crazy, right? There is still a lag effect, right? In other words, like that doesn't get into financial assets the next day, right? Unless they're actually out there doing asset purchases, which they've done in the past, but they mostly keep that to treasuries, right? My point there being is given the extreme amount of froth, can the Fed really intervene quickly enough to avoid the cascade in the equities?
That's a really good point, because when the Fed cut rates in 2000 and before 2007 even, market kept falling. It wasn't until 2000 and late 2008, 2009 when they started QE1 that they turned things around. They have to print, but first they'll have to cut rates, and that takes time. And the markets decline because the market sees that the Fed is cutting rates because the economy really isn't good. And so initially, yeah, rate cuts, they don't help at all. It's a negative for the market, and it does take time. It'll take time for the Fed to get to a point where they're going to say, with still inflation now here, which they didn't have before, higher than their target rates, am I going to start printing again? So you could have a lot of damage before you get to that point.
Okay. All right. I hate to start wrapping things up here because this is such a great conversation. And I know I'm going to get a lot of abuse for wrapping it up here, but we're getting close to the hour. So Fred, where do you see the opportunity here? I'm assuming you probably see some opportunity on the short side. I think you probably see opportunity just to play it safe and maybe, position yourself defensively. Obviously, maybe there's some opportunity on the short side. That's not obviously for everybody, but I'm curious, are you already going short in certain cases? And then where do you see, long opportunities in other assets? And I'm not asking the question for this reason, but I know that historically you've had a pretty good sanguine outlook for gold, and I'm wondering if that remains the case.
Yeah, first on the short side, I learned decades ago that I didn't want to short because I saw how crazy things can get as they are today. You never know how high is high. You never know when these manias will break. So the way I did, I'm talking about what I'm doing now is I'm putting on the 2000 playbook, and that was to buy long-term leap puts against some of the largest, most overvalued tech stocks. So we talk about that. So I have just recently added, kind of increased, I had a very tiny position for the longest time, but I've increased my positions against Apple and Nvidia. Now these don't expire until late 2025. So I have some time and for all of this stuff to happen, to unwind, because they don't know the timing of it. But it's small amounts. It's less than 1% of my portfolio. It could have an impact if these things fall. Like if Nvidia was to fall another 90%, I'll make some money on it. But it's a very small percentage of my portfolio. I won't short. And the reason why I do these very big ones, besides the fact that they're grossly overpriced, is that the premiums are relatively
Low.
reasonable. Whereas if you try to go after a super microcomputer, another AI beneficiary, premiums are crazy. So I learned that, and that's what I did in 2000. I went after the large cap stocks like Intel. That was my favorite. And bought leap puts because I didn't know the timing, and eventually it paid off. But it's a very small percentage of my portfolio. A bigger percentage of my portfolio was in treasuries, where you can still get 5.25% short term. I'm not taking any duration risk, and I was able to do that in 2000 as well. I had a lot more in treasuries at that point. So I have a lot of treasuries at 5.25%, and that will give me the opportunity to buy if we get a decline in the markets. If the Fed comes in, I can buy. If we wash out and the value stocks are valuable, then opportunity, then I can move that money from the treasuries into that. It gives me opportunity. And then finally, I have a large positions in the metals. I've had the gold position on ever since the Fed started going crazy 23 years ago. I had the metals. I haven't given up on those just because the Fed continues to do what they do, which is debase the currency, and obviously our budget deficits and debts. Now, the best area is the gold miners, and they haven't performed as well as gold. Usually they outperform the market. Usually they outperform the market by 2 to 3 times. Well, right now they're underperforming gold. Gold was up 13%. The miners are only up 7% this year, and they've been underperforming. And then the reason is because it's the Chinese, the Indians, and the Middle Easterners. They account for 75% of all gold buying in the world. But it's the U.S. and Canadians who account for the gold miner buyers. So the U.S.-based and Canadian-based miners. There's no interest there whatsoever. The GDX ETF has the same number of shares outstanding as it did in 2018 when gold was 1,180. And yet it's doubled. No inflows whatsoever. The stocks are cheap. The beautiful thing is that with the price of gold rising $270 this year, actually from last quarter, to an average of $2,340 in this Q2, margins are going to increase about 40% on average, because you're going to have 2,340 average gold price, and you're going to have $1,350 dollar all-in sustaining costs. You're going to have $1,000 in margin. That's going to be up nearly 40%, and yet the stocks don't reflect that. For example, Agnico Eagle, which is one of my favorites, it had earnings of 76 cents in Q1. They're going to have a big jump in their margins and their earnings, and the analysts have 77 cents for Q2. And similar things where the analysts haven't even moved their numbers because nobody cares. There's no interest in these stocks. And so there's this great opportunity for the gold miners themselves to catch up in a big way. And that's what they do. You get triple-digit moves in miners when the trend is their friend. It was massive in the gold bull market in 2000s. They went up by 17 times. But we've seen just 100% in kinds of increases before in other bull markets that we've had since then. So they're really undervalued. They're right on the cusp of showing massive improvements in their earnings and their cash flows and their increases in dividends and all of that. And it starts in the end of July into August, which is also around the same time that the physical gold buying, which is at a low right now seasonally, starts to improve for the gold market too, globally. So I think that's my favorite area, and I'm expecting big things from them.
So it sounds like you see us on the cusp of 2 important trends. One is the larger Wall Street waking up to the fact that, whoa, we really went overboard on this whole generative AI thing, and that sentiment there may tip from bullish to bearish. And then on the precious metals, that the street might finally wake up to the fact that, hey, there's some pretty amazing margin growth going on in the space. We need to start allocating capital there, and that should hopefully bring the miners to life.
They usually go in opposite directions.
Yeah.
Stocks and gold, and the miners go with gold usually. They go in opposite directions. So that's what I'm hoping we'll see.
Okay. All right. Gosh, we're going to have to wrap it up here, but Fred, just phenomenal. So most important question of the conversation, for folks that have really enjoyed this, would like to follow you and your work, where should they go?
First of all, I'm on Twitter, HTSF Hickey, at HTSF Hickey. That's what it is. And then also, if you're interested in the newsletter, we'll send all the details if you send us an email to the High Tech Strategist at yahoo.com. THEHIGH, strategist as it's spelled, at yahoo.com.
All right, great. And Fred, when I edit this, I will put up the URLs to both your Twitter handle and to your email. Thank you for generously sharing that. Folks, I'll also put the links in the description below this video so you can get there with one click too. All right, Fred, I got one last concluding question for you, which I'll give you a second to think about, which is, what's a big lesson you've learned across the course of your career that you think is worth sharing with the audience here? Very quickly, folks, if you'd like to thank Fred for coming on and sharing so much amazing insider insights with us, please ask him, please let him know that and invite him to come back on the program as soon as he's got an update to his outlook by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Just an important reminder, and I should have said this earlier, Fred, nothing of what Fred mentioned there is personal investment advice. It's just his general observations as a market analyst. If you would like personalized investment advice, I highly recommend that if you plan on taking any steps based upon, some of what Fred shared with us here, that you do so under the guidance of a good professional financial advisor and one who understands all the macro issues that Fred and I talked about. When you put those two requirements on top of each other, the universe of good financial advisors who take all that stuff into account actually gets pretty small. But if you've got a good one who can do that for you, great, work with them. If you don't, or would like a second opinion from one who does, then consider scheduling a free consultation with one of the financial advisors that you see on this channel with me every week. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. These consultations are totally free, no strings attached. And once you fill out the form, the advisors will be in touch with you within the next 24 hours. All right, Fred, so we're here at the very end. You've had a highly successful career. Your newsletter is one of the most respected in the financial newsletter industry. What is an important lesson that you've learned along the course of your professional journey that you think is worth sharing with the audience here?
Patience as an investor. So I had to wait in 2000 for the market to break and for value stocks to be, for tech stocks to come back into value, and I could buy them again into October 2002. Same thing in October of 2009. I was able to buy them once the market broke. Patience to make sure that you're not going to chase because everyone else is valuations that are crazy. You just have to wait it out and wait for the right moment. I think that's the most important thing. It's easy to say, it's very difficult to do. When everyone else seems to be getting rich around you, you just have to be patient and know that there'll be reversals to the mean. And if you're buying value, you will eventually be rewarded.
All right, very, very well said. I have other experts on this channel that have echoed that, Fred, but very meaningful coming from someone has such a long-term success record like yourself. And it is hard when you're an individual investor. Sometimes the smartest thing to do is just sit on your hands, even though your emotions are driving you, to make some sort of trade, given the latest headline that you've read or whatnot. But patience, waiting for the right trade-off in terms of price to value, all that stuff. It's not for nothing, but they have those studies, which might be apocryphal, but they still make the point. Fidelity and a lot of brokerages like that, they oftentimes say that their best performing results, best performing portfolios are those of dead people or people that forgot that they had accounts with them, that they just didn't trade. And because they weren't in there mucking around, they actually got to have uninterrupted performance over the long run. But anyways, Fred, thanks so much. Absolutely wonderful, fascinating discussion. Really look forward to having you back on when some of the things that you think may happen when those shoes really start dropping, but can't thank you enough.
You're welcome. Always a pleasure.
All right, everybody else, thanks so much for watching.